Hey guys, Jake here, and in this video we're going to be talking about your wealth potential. Hey guys, Jake here, and in this video we're going to be looking at how much you're actually worth, what we call your wealth potential, and then we're going to be talking about where that money is lost, how it's eroded out of your finances and things like taxes and debt and interest and other expenses. And then we're going to focus on this idea of, should I chase that rate of return? Should I really, focus on where can I go get a better rate of return? Or should I focus on where my money is going? So we're going to take an example of, we're going to kind of look at a 30-year period. And really this is going to apply for, if you're 40, it's going to apply for another 50 years. If you're 50, probably another 40 years. Really, up until the end of your life, these things are going to matter. But we're going to look at a 30-year window because it's going to give us a good picture of what's happening. So we're going to make a couple assumptions. We're going to assume that you make $100,000 a year, and that every year that you're earning money, you're increasing that salary or that income by 3% every single year. So you're getting pay raises, whatever that might be, but that is going to increase every year by 3%. So what we want to look at is we want to look up here in this top right corner. It says summary of values, and we're going to be referencing this a lot as we go. What you're going to see is it shows the first year the total income of $100,000. The last year, meaning 3% increase a year for 30 years, that income is going to be $235,000. And on average, that you'll earn about $158,000 a year over that 30-year period. Okay. So what that means is if we were to just add up all that income that you could earn over that 30-year period, you would earn about $4.7 million just in income. So your earning potential is upwards of $5 million. Okay. Now, the other assumption that we're going to make is if we were to take all that income, that $4.7 million, and instead of just have it and add it up, what if we actually were to put that money to work? What if we were actually able to earn a 5% rate of return on that money every year that we had it? Well, what that would do is it would take that $4.7 million of income and it would move it upwards of $10 million. So $9.9 million of what we call wealth potential. So income potential, 4.7 million, and total wealth potential at 5% of $9.9 million. That's a lot of money, right? So if you were to ask, yourself, well, you knew you were going to make $10 million over the next 30 years, and someone asked you, well, how much of that do you think that you're going to actually end up having after 10 years? A lot of us would say, my initial thought would be, oh man, $5 or $6 million bucks probably. Pretty easily. I think I'd keep a majority of that. But we're going to look at how that starts to be eroded when we look at life, when we look at expenses. I mean, obviously we can't take every dollar and just throw it in an account. We have taxes, we have debt, we have to live, we have all those things. So now that we've got our wealth potential, let's go ahead and take a look at the first thing that we're going to talk about, and that's taxes. So taxes are an interesting subject, and we could probably talk about them for much longer than we have time for. In fact, we'll be doing a specific video on it here shortly, so keep an eye out for that. But let's go ahead and assume the average income here is $158,000. So we'll just assume a 25-30% tax bracket. Plus, you're going to be paying taxes locally. So depending on your state, those could be higher, could be lower. So we're going to assume a 35% tax immediately on that money. Okay. But that's not the only tax that we pay. Those are our direct taxes or our income taxes. Let me show you this real quick. This is a list of taxes we pay in the U.S. So as I start scrolling down here, you'll see that we pay a lot of taxes in the U.S. You'll see we have federal income tax right there, number 46. But the taxes that we pay are far more than just our income taxes. That's one of, let's scroll down here and just show you how many we have. There could certainly be more, but we have 201 listed here. So there's a lot more taxes than we pay than just that income tax. We have vehicle registration tax. It shows a vehicle license. Unemployment taxes. If we have a business, we pay self-employment taxes. We have telephone taxes, a long list of them there, as you can see. We have sewer and water taxes. We have a Social Security tax. You can really see the list here goes on. A big one there is property taxes. So we have a really long list of taxes that are going to be paid. So to assume that we're just going to pay income taxes is really neglecting some of the real issues or real taxes that we pay. So there's probably another 10% that we pay in taxes there. I'm going to reduce that to just 5% more. I think that's very fair. I think that's probably conservative. But what you'll notice is that we went from $9.9 million of total income to just under $6 million of income or future wealth potential down the road from taxes alone. So that's the first thing that we have to take into account. So a big bill there, close to $4 million we're losing there in taxes. So the next thing we go through is our debt service. So debt is obviously what we pay in the form of loans to financial institutions, banks. So what I want to do is I want to actually look at a couple examples of loans and how these work. So most people, between their mortgage and their if they have credit cards or car loans or a couple car loans and student loans, we're easily paying 25, 30, 35%, maybe more of every dollar that we earn on our debt payments. And so it's important to understand how that money works. So let's say I've got a $20,000 loan at 8% for some kind of car, right? And we'll assume 60 months on those payments. And this is going to vary. This could be way more interest on a car loan. It could be less. In the environment we're in today, it's going to be less. But this is just to give you an example. This could be a variety of different things. And I'm going to look out over this 60-month period. And I want you to notice kind of how this lays out, how this amortization chart lays out. So we've got $20,000 balance, and the first payment that we make of our $405 payment, $133 of it goes to interest. Okay, and what you'll notice is there's a high amount of interest that goes towards this payment for these first years, and it starts to slowly decrease, and by the end, our last payment has $2.69 of it go towards interest. So very high volume in the early years of interest and lower as we go. But on average, total payments, total interest we pay is $4,332. The total amount we've paid is $24,000. So we're looking at 20 cents on average of every dollar we spend goes to interest. So a large percentage of the money that we have goes out the door in interest when we make those payments. But that's kind of just the beginning. If you've got a $200,000 mortgage payment, then we'll reduce this down to call it 6% for 360 months. That's going to equate to $231,000 of interest paid versus $431 of total payment. So more than half, more like 55% of every payment is going towards interest. So high volumes of interest. So here's how this works. Obviously, if we pay this off like this is what we expect, but this isn't exactly how reality plays. In fact, I bought my house a couple years ago. I think maybe close to 4 years ago now. And this is what's happening for me. So look at this first month. So we've got $1,000 paid in interest. We've got $199 towards principal. That's a large percentage there. That's close to more than 80% of that payment is going towards interest. And that remains that way for the first long period of time. It slowly dwindles. So let's say we've got 5 years, 930 versus 267 towards principal. 930 of a $1,200 payment is going towards interest. So what'll happen is you'll start getting in the mail offers for a refinance. And I get these all the time. Essentially what these banks want you to do is to reset this calculation, right? Extend the mortgage, reset this interest so that the larger percentage of that payment is going towards interest. Okay, so at the end of the day, if we recycle that and we continue to refinance, we really don't get ahead. We just keep paying large volumes of interest these banks. And so it's important to understand that as we look at debt service, because a large percentage of what we pay is in interest. A lot of that expense that we pay is interest. And what we'll show you, and I'm going to walk you through here, is how the infinite banking concept is going to allow you to recapture those interest dollars. Be able to redirect those dollars that are going out to someone else back into you, to your account, to you, to build up your wealth as opposed to someone else. So if you maxed out the mortgage you got, and you got the most the highest debt to income ratio you could, or whatever. I mean, we're looking at we could look at 40 to even 50 cents of every dollar going towards debt service here. But I'm going to go ahead and assume it's more like 35. That's pretty typical with a mortgage and with student loans and cars and credit cards. So already we've got, out of the close to $10 million we had of value. Let's look at these summaries again. We're down to $2.4 million of future savings, and we haven't even survived yet. We haven't paid a gas bill. We haven't eaten any food. We haven't really entertained any lifestyle at all. And so we need to figure out how much of our money is going to lifestyle. So I'm going to assume that you're going to have, I'm going to throw kind of an oddball number of 13% going to lifestyle. That's pretty meager. Most people probably spend more than that, certainly in their lifestyle. But I'm going to assume another 7% going to other costs, insurances, health, auto, life, all those different insurances that we have to pay for, and those other costs that surface that aren't necessarily tied to your lifestyle, that are kind of tied in a roundabout way to some of those other things. But at the end of the day, after we take out all of these expenses, we're saving a net savings rate of about 5%. So that's pretty average. In fact, a lot of times people are in the negative on this number. That's why credit cards are racking up limits. They're getting close to those limits and racking up a lot of credit card debt because they're actually spending more than they are making. But this is more typical. We're seeing about 5% savings rates. So we've gone from $10 million of total future wealth potential, and we've dwindled that down to less than $500,000. Now, if you're 30 and 35 and you retire at 65 and you've got $500,000 in the bank, and you're living the rest on Social Security, that's pretty typical. I must say, for most people that make $100,000 a year, to have $500,000 or $600,000 in the bank as they plan to retire at around 65, that's actually doing pretty good. Most people aren't doing that well and will continue to work for longer, or work part-time, or live on a lot less. But a lot of money is eroded there. So the question becomes, all right, in fact, let's assume, let's kind of take two roles here. Let's assume that I'm, a really great financial advisor, and I'm just really good at picking winners. So you come to me and you say, okay, look, here's what I got going on. I'm saving, $5,000 of my $100,000 a year, and so I'm going to say to you, okay, well, so you're saving 5%, great. What returns are you getting on that 5%? And so 5%, and then advisor will say, well, that's okay, I guess, but I can get you 7 or 8. That's pretty good, and that's after fees. So let's assume I can go ahead and get 7% every single year, without missing. So we went from $500,000 to almost $700,000. It's almost $200,000 better by focusing on rate of return. Now, granted, I could end up with far less by taking more risk. More risk does not necessarily mean more reward. It just means more potential for loss. So that's the result. So $700,000, we'll call it $700,000 by focusing on getting a better rate of return. Let me bump that back down. So now let's say, instead of being the greatest guy and financial advisor at picking stocks and picking winners, instead, we utilize a strategy that can bring money back to the table, can recuperate lost interest, can reduce taxes, can reduce some of our other costs. Let's say instead that's what we focus on, and that is indeed what the infinite banking concept is about. It's about bringing those dollars back to the table. Well, immediately we're going to find some tax value because, as you'll find, it's a tax-free environment that has ability to reduce taxes and ultimately save money by reducing those taxes. Let's say we can bump that down just a little bit. Let's say that instead of paying all this interest to third-party lending institutions, I can redirect that back to my pool of wealth, right? I'm gonna be super conservative and just reduce that by about 5%. Redirect just simply 5% of that. Lifestyle, I'm actually gonna say let's increase that a little bit and then reduce some of these insurance costs. Finding money there, which is very typical. We're able to do that. So if instead of focusing on the rate of return, we focus on reducing and finding money inside of these areas, we're going to go from that $500,000 to close to $1.5 million. So it's $1 million more as opposed to $200,000 more by not taking a single percentage risk more, without increasing that risk to any degree. This is huge. This is very important to understand, because there's really a lot more we can do by finding the money that's being lost. I mean, think about it this way: you've got $100,000 that you're earning, and $5,000 of that is going to savings. Well, if we can earn 10% on that saving, that's $500 increase. Well, that means $95,000 is going somewhere else. It's leaving. It's going to someone else's pool of wealth, really. So instead of focusing on that 5% and trying to up that return to that 10% and having that earn $500, what if we could just recuperate 1% of that $95,000? That's $950. That's almost a 20% return on the $5,000 that's being saved. Much, much more effective. Now that doesn't mean you can't go out and chase winners or start a business or invest in real estate or something that can produce better growth. But we're reducing all of that lost money. We're bringing it back to the table, and then if we can increase that growth, now we're doing even more benefit. So not to say that we want to chase returns. We want to focus on where that money is going and the flow. But ultimately, at the end of the day, we're talking about something far more valuable and focusing on where your money is going as opposed to focusing on that rate of return. So I hope that helps. That's the purpose of the infinite banking concept, is to help you see that wealth potential and keep more of it, as opposed to seeking a greater rate of return and risking more of your small capital. We want to bring more capital to the table, and that's what that accomplishes. So for most people that find this idea really helpful and are interested in how they can recapture more of their money as opposed to risking more of their money, some of the resources below are going to be really helpful. There's a link to the taxes that we looked at. There's a link to some more information. So go ahead and click on those, and that will really help further that education and expand and understanding more how that infinite banking concept can actually help do and perform these things. So thanks, and I hope you enjoyed it.